Here's a paradox hiding in plain sight. If Walmart eliminated all store manager bonuses, it could boost pay for its 1.6 million U.S. employees by $10 an hour, a change that would mean an $800 million increase in weekly payroll. This is possible only because the company's 2025 store-level compensation structure is built to create sharp pay gaps, with market managers eligible for packages up to $620,000 a year, even as Walmart reports just 3% net margins on $680 billion in annual revenue. Walmart's approach relies on stock grants and aggressive bonus targets to make store managers operate with an ownership mindset, focused on every fraction of profit inside their multimillion-dollar stores. This system, while controversial, has become a core part of how Walmart maintains its massive scale and influence. The question is, how does this strategy hold up when the margins are so thin? The Walmart paradox: high pay amidst thin margins. At the heart of Walmart's business is a dynamic that seems almost contradictory. The largest private employer in the United States, operating on some of the narrowest margins in retail, yet offering store managers compensation packages that rival those found in finance or tech. This is the Walmart paradox: high pay for a select few, funded by relentless efficiency and a scale few companies can match. Walmart's 2025 net profit margin stands at just 3% of sales, a figure that would alarm most retailers. Yet, the company's store managers, if they hit performance targets, can earn upwards of $600,000 a year. This is all built on a foundation of immense volume. Each Walmart location generates, on average, $130 million annually, and the company's total revenue for 2025 is projected to reach $700.8 billion. These numbers are staggering, but they only tell part of the story. While Apple and Microsoft post net margins of 25% and 40% respectively, Walmart survives by moving products at breakneck speed and keeping costs ruthlessly low. Every 1% increase in store efficiency translates to millions in additional profit, and for a company with thousands of locations, these small improvements add up quickly. The compensation structure is engineered to extract maximum performance. Store managers start with a base salary of $128,000, but the real incentive comes from bonuses, which can more than double their pay. Performance metrics are precise. 30% of the bonus is tied to sales growth, 20% to inventory shrinkage, and 50% to profit before tax. This creates a culture where every detail is scrutinized. For example, at one Texas store, optimizing shelf restocking routines for produce reduced shrinkage and saved $200,000 in annual losses. These kinds of operational tweaks are not isolated incidents. They are the expectation, and they're tracked daily. The contrast between the compensation of managers and hourly workers is stark. While store managers chase six-figure bonuses, the average hourly wage at Walmart is $17.50, leaving many employees eligible for public assistance. Internal records reveal that Walmart employees account for a significant share of Medicaid recipients in several states. The company argues that its pay model reflects the economic realities of retail. Replacing a cashier costs about $3,200 in training and recruitment, but losing a seasoned store manager can cost up to $150,000 in lost productivity and disruption. Walmart's approach is not unique among large-scale retailers, but its scope is unmatched. Amazon's warehouse managers can earn up to $160,000, and Costco's store directors average $250,000, but Walmart operates at a scale that dwarfs its competitors. With more than 4,700 U.S. locations, even the smallest efficiency gain is amplified across the network. A single supercenter processes around 6 million customer transactions per year. If managers can shave just 1 cent off each transaction, that's $60,000 in extra profit per store and billions company-wide. The economic influence of Walmart extends far beyond its own payroll. Each supercenter injects about $18 million annually into local economies through wages and vendor contracts. At the same time, Walmart's aggressive pricing has a deflationary effect on entire regions. Studies show that grocery bills in communities with new Walmart stores drop by 5 to 8%. This widespread price suppression often benefits consumers more than the wage increases that critics demand, creating tension between the company's labor practices and its impact on household budgets. Inside the stores, Walmart's measurement culture is relentless. Managers receive daily profit and loss statements broken down to individual departments. They track sales per labor hour with the same intensity that tech firms monitor user engagement. Proprietary inventory systems can predict sales within a 2% margin of error, allowing managers to adjust staffing and stock levels with precision. This data-driven approach is not just about efficiency, it's about survival. With such thin margins, even minor miscalculations can erase profits for an entire quarter. Inventory turnover is another key to Walmart's financial engine. The company turns its entire inventory every 42 days, nearly twice as fast as traditional grocers. This rapid turnover means Walmart earns its 3% profit margin more than 8 times a year, leading to an effective annual return on assets that exceeds 15%. In other words, the company's low margins are offset by high velocity, and it's the managers who are expected to make this system work. Labor costs at Walmart are kept unusually low, accounting for just 9.8% of operating expenses compared to 15 to 20% at competitors. The bonus structure incentivizes managers to trim labor hours wherever possible. If eliminating 50 unnecessary labor hours per week helps a store hit its targets, managers will make those cuts, something less motivated salaried managers elsewhere might overlook. Walmart's internal calculations show that top-performing store managers generate 3 times their compensation in additional profit through these efficiency gains. This compensation system creates what economists call a tournament model. A small number of high earners at the top inspire thousands of employees to compete for promotions. Walmart fills 76% of its store management positions with internal candidates, building a pyramid where the prospect of a 6-figure salary is visible but statistically rare. The average store manager spends 12 years with the company before being promoted, often starting as an hourly associate. The promise of upward mobility is real, but the odds are long. The pressure to retain top managers is growing. While Walmart has increased starting wages by 27% since 2020, inflation has eroded much of those gains. Meanwhile, manager bonuses have climbed 42% in the same period, as the company prioritizes retention in a tight labor market. Competitors like Amazon and Target have started offering significant salary increases to lure away Walmart's top performers. Walmart's answer is to emphasize the life-changing potential of its management track, noting that 62% of its store managers are first-generation college graduates, people for whom these earnings represent a dramatic shift in financial security. There are signs that the model delivers benefits even for employees lower on the ladder. Walmart promotes hourly workers to department manager positions, paying $45,000 to $65,000, faster than most competitors. The average time to promotion is 18 months, compared to 4 years at traditional supermarket chains. The company also offers tuition assistance through its Live Better You program, though participation rates remain low due to demanding work schedules. Walmart reinvests the vast majority of its profits, 93%, back into expansion and price reductions. Rather than hoarding cash, the company uses its efficiency gains to open new stores and lower prices even further. This creates a cycle where lower prices drive more volume, which in turn justifies larger stores and greater economies of scale. The managers earning $600,000 are rewarded not for innovation, but for perfect execution of a system that depends on relentless cost control and operational discipline. Industry analysts see Walmart's compensation strategy as the linchpin of its business model. The same efficiency that enables everyday low prices also funds the bonuses that keep top managers engaged. The results are measurable. Stores led by high-earning managers post 11% better sales growth and 23% higher profitability than the corporate average. In a sector known for brutal competition and razor-thin margins, that difference can mean the survival or failure of a store. Yet, this entire system is precarious. With profit margins so thin, even minor disruptions, rising labor costs, supply chain hiccups, or new tariffs can threaten the delicate balance that sustains Walmart's scale. The company's ability to maintain its paradoxical compensation model depends on constant vigilance, aggressive cost control, and the willingness to reinvest nearly every dollar earned. The financial statements for 2025 offer a window into how this strategy is put to the test at the largest scale in retail history. The 2025 Financial Breakdown. Examining Walmart's 2025 financial statements reveals the inner workings of a company that has become synonymous with scale, efficiency, and relentless cost control. The numbers speak for themselves. Walmart generated $680.99 billion in annual revenue, holding its place as the world's largest corporation by sales. This figure is nearly double Apple's $395 billion and comfortably ahead of Amazon's $638 billion. Despite this, Walmart's market capitalization sits at $760 billion, a fraction of Apple's $2.9 trillion and far below Amazon's $2 trillion. The reason for this gap is straightforward. While Apple keeps 25 cents of every dollar in revenue and Amazon enjoys tech-level multiples, Walmart's net profit margin is about 3%. For every $100 in sales, Walmart retains roughly $3 after covering the cost of goods, labor, logistics, insurance, advertising, and the upkeep of its vast store network. The company's Q4 2025 results offer a window into both the strengths and the underlying fragility of this model. Walmart posted $180.55 billion in revenue for the quarter, up 4.1%. U.S. comparable sales rose by 4.6%, driven primarily by grocery, which accounts for 65% of domestic revenue and saw mid-single-digit growth. General merchandise sales, however, remained flat, underscoring the ongoing shift in consumer spending patterns. The company's U.S. e-commerce business expanded by 20% in the quarter, while global e-commerce climbed 16%. These digital gains were supported by investments in faster delivery and a broader marketplace assortment, but they came with the trade-off of thinner margins. Walmart's global advertising business, including Walmart Connect, grew 29% in Q4, and the company's membership income continued to post double-digit growth, further diversifying its revenue streams. Walmart's acquisition of Vizio in early 2025 signaled a push into higher-margin advertising and data-driven businesses. While the company expects a 150 basis point headwind to operating income in fiscal 2026 as it integrates Vizio and laps the leap year. The move is designed to position Walmart as a credible rival to Amazon in retail media and connected TV advertising. The payoff is clear. Advertising now delivers $3.1 billion annually at 75% gross margins, compared to the core retail business's 24%. This shift toward digital and advertising revenues aims to cushion the impact of Walmart's razor-thin margins in its core operations. Velocity remains the foundation of Walmart's profitability. The company turns its inventory 8.7 times per year, essentially a full rotation every 42 days. This means that the modest 3% net margin is realized on each dollar of inventory nearly 9 times annually, producing an effective return on assets of about 26%. By comparison, specialty retailers may report 8% net margins, but turn inventory only twice a year, resulting in much lower asset productivity. For Walmart, the stakes are high. A single day's delay in inventory turnover translates to a $400 million reduction in annual profits. Walmart's ability to move such massive volumes at scale is supported by an intricate web of cost-cutting and operational discipline. Its private truck fleet, the largest in the world, moves goods at 8.2 cents per ton-mile, about 30% below the industry average, by maintaining a 94% load factor. Store layouts are continuously optimized. In 2025, a pilot program in Texas stores, relocating rice and pasta closer to canned goods based on detailed purchase pattern analysis, saved $23 million annually. Even minor adjustments, such as switching to a narrower case sealing tape, netted $28 million in shipping cost savings. These micro-optimizations, when multiplied across 4,700 U.S. stores, add up to billions in annual savings. The company's procurement division processes $500 billion in purchase orders each year, giving Walmart unmatched leverage over suppliers. This leverage extends beyond product pricing to details like packaging materials and even ink color, all in service of shaving pennies off costs. Walmart's investment in technology is equally significant. Its inventory management systems track the movement of individual products with 98.4% accuracy, minimizing both overstock and out-of-stock situations. This precision ensures that shelves are stocked with what customers want, when they want it, without tying up excess capital in unsold inventory. Walmart's scale also creates a deflationary force in the markets where it operates. According to USDA data from 2025, the company's pricing power reduces grocery bills by 5 to 8% in its regions. This effect ripples outward, forcing competitors to lower their prices or risk losing market share. In staple categories like paper goods and cleaning supplies, Walmart negotiates wholesale costs that are 12 to 15% lower than regional chains can achieve. This price gap is insurmountable for smaller competitors without similar scale, leading to a feedback loop where Walmart's dominance continues to grow. Yet, the same scale that drives Walmart's efficiency also exposes it to unique risks. Labor costs are a constant pressure point. A 1% wage increase for Walmart's 1.6 million U.S. employees would add $580 million in annual expenses, about 9% of the company's net income for 2025. The company's IT infrastructure is another area of vulnerability. Walmart spends $900 million annually on cybersecurity to protect a network that processes 2.3 million transactions per hour. Supply chain disruptions, such as those caused by Hurricane Ida in 2025, can quickly escalate. The hurricane temporarily raised Walmart's inventory carrying costs by $87 million per month until normal operations resumed. The company's approach to management compensation reflects its focus on retention and performance. In 2025, Walmart raised market manager base pay by nearly 25%, from $130,000 to $160,000, and increased the annual stock grant from $75,000 to $100,000. The bonus potential also rose, with managers now able to earn up to 100% of their base salary as a bonus. This means that on the lower end, annual compensation for market managers can reach $420,000, while top performers could see packages as high as $620,000. These increases are not just about rewarding performance. They're a calculated investment to reduce turnover, which costs the company up to $150,000 per manager lost in productivity and disruption. Data from 2025 shows that stores with managers retained for 3 years or more posted 11% higher profitability than the corporate average. Walmart's efforts to diversify its revenue streams are paying off. The global advertising business, powered by both in-store data and the Vizio acquisition, has become a significant margin driver. Connected TVs in 18 million homes now offer Walmart a direct line to consumers, enabling the company to tie ad exposure to both online and in-store purchases. The company's membership programs, such as Walmart Plus, continue to grow at a double-digit pace, further locking in customer loyalty and providing recurring revenue. Wall Street, however, remains cautious. Despite Walmart generating 72% more revenue than Amazon, it trades at just 0.3 times sales, compared to Amazon's 3.2 times. Investors view Walmart as a low-growth, asset-heavy utility rather than a nimble tech platform. Part of this skepticism stems from Walmart's real estate holdings. The company owns 90% of its stores, with $105 billion in real estate assets on the balance sheet. While these assets provide stability and control, they are seen as costly liabilities by many investors, due to ongoing maintenance and limited flexibility. Stock performance reflects these perceptions. From 2020 to 2025, Walmart shares appreciated 42%, just ahead of the S&P 500, but well behind Amazon's 85% gain. Institutional investors hold only 32% of Walmart's shares, compared to 58% for Amazon. Even Berkshire Hathaway, long known for favoring stable, cash-generating businesses, holds more Amazon stock than Walmart, despite Walmart's business aligning more closely with the firm's historical investment philosophy. Walmart counters this narrative by emphasizing its financial resilience. The company has raised its dividend for 49 consecutive years, with a current yield of 1.4%. In 2025, Walmart repurchased $5.8 billion in shares, returning capital to shareholders without the need for high-growth multiples. The company's defensive qualities are evident during periods of economic uncertainty. During the inflation spike of 2023, Walmart gained market share as consumers traded down to lower-priced options. Its beta of 0.42 signals less volatility than Amazon's 1.18, making Walmart a stabilizing force in many investment portfolios. International operations provide another layer of stability. In 2025, Walmart's overseas businesses, especially Flipkart in India and Walmex in Mexico, returned to profitability after pandemic-era disruptions. These segments operate at 4.2% margins, nearly double those of U.S. stores, thanks to lower labor costs and less intense price competition. With 5,300 international locations, Walmart's global footprint now contributes 23% of total revenue and 38% of operating income. Looking forward, Walmart's financial model is both a strength and a source of vulnerability. The company's ability to operate on a 3% net margin is a competitive moat that few rivals can match. Even a 1% difference in gross margin, 23% at Walmart versus 24% at a competitor, translates to $6.8 billion in annual savings, which Walmart passes on to consumers through lower prices. This relentless focus on cost and efficiency ensures that Walmart's price leadership remains unchallenged. Store managers earning up to $620,000 are not tasked with reinventing retail, but with executing a proven formula that depends on scale, discipline, and precision. This financial discipline, while effective on a global scale, also has profound effects at the local level. The presence of a Walmart supercenter alters the economic landscape of entire communities, setting off changes that ripple far beyond the company's own operations. When a Walmart supercenter opens its doors, the surrounding economic environment shifts in ways that are both immediate and far-reaching. Economists and city planners refer to this as the Walmart effect, a term that captures the measurable changes in local commerce, employment, and even household budgets within a radius that can extend up to 50 miles. The arrival of a single Walmart store is enough to statistically alter the economic makeup of an entire region, a phenomenon documented in dozens of studies and felt by communities across the country. One of the most visible consequences is the closure of nearby businesses. A landmark study on the outskirts of Chicago tracked the aftermath of a new Walmart opening and found that within 2 years, 82 businesses in the area had shuttered. The impact was most severe within 1 mile of the store, where closure rates ranged from 35% to 60%. The effect tapered off with distance, but its reach was clear. Hardware stores, toy shops, and pharmacies were among the most vulnerable, with closure rates between 45% and 60%. Service-oriented businesses like salons and repair shops proved more resilient, though even they saw closure rates between 12% and 15%. Similar patterns have been observed in other regions, confirming that the economic blast radius of a Walmart extends well beyond its immediate vicinity. The effect on local labor markets is just as pronounced. Data from the Bureau of Labor Statistics reveals that counties welcoming a new Walmart experience a 6.2% decline in retail sector wages within 5 years. This wage suppression is not limited to Walmart's own employees. Rather, the company's pay scales become the regional benchmark, prompting competitors to adjust their compensation downward to remain viable. A Montana State University analysis found that full-time retail wages in communities with new supercenters dropped by an average of $1,872 annually, contributing to an 8.3% increase in poverty rates in rural areas. The downward pressure on wages extends even to workers who never set foot inside a Walmart. Walmart, for its part, disputes the narrative of net economic harm. The company's commission studies highlight the jobs created with each store opening, typically around 300 direct positions, plus an estimated 85 indirect jobs through increased economic activity. Walmart emphasizes that a significant proportion of new hires, about 74%, come from local unemployment roles. However, independent analysts note that many of these positions are part-time, averaging just 31 hours per week. Walmart-funded research also spotlights the consumer savings generated by its presence. Households within 15 miles of a supercenter save an average of $1,247 annually on groceries and essentials, amounting to billions in aggregate consumer surplus. These savings, the company argues, offset the negative impacts on wages and business closures. The urban-rural divide in Walmart's impact is stark. Rural communities, where retail competition is often limited, see more dramatic business closures, but also reap the largest consumer savings. USDA Economic Research Service data shows rural areas experience 28% more business closures than urban markets after a Walmart opens, but also enjoy 37% greater savings at the checkout. The lack of established chains in rural regions means independent retailers are less able to withstand Walmart's pricing power, while consumers in these areas gain access to a broader selection of goods at lower prices. The types of businesses most at risk are well documented. Local grocers without unique offerings face a 58% closure rate. Regional discount chains and pharmacies lacking healthcare services see closure rates of 43% and 51%, respectively. The competitive pressure extends beyond retail. Walmart's ability to set regional wage and price floors means even larger chains must adapt or risk losing market share. A study examining price responses in 10 commonly purchased items over 2 decades found that competitors within Walmart's sphere of influence reduced prices by 1.5% to 3% in the short term and by 7% to 13% over the longer term. These permanent price reductions benefit consumers, but reset profit expectations for entire sectors. Walmart's dominance in local labor markets is most pronounced in towns with populations under 75,000. A 2025 Harvard Business School review of 12 Midwestern counties found that Walmart became the largest private employer within 3 years of opening, controlling between 22% and 38% of local retail employment. This concentration gives the company wage-setting power, with competitors consistently paying 8% to 11% below pre-Walmart averages, while increasing productivity demands by 15% to remain competitive. In effect, Walmart's arrival restructures the entire local job market, not just for its own employees, but for anyone working in retail. The economic trade-offs are difficult to ignore. On one hand, research from Puget Sound Sage estimates that each Walmart store reduces a community's economic output by $13 million over 20 years, with an additional $14 million in lost wages over the same period. On the other hand, Walmart's own data contends that each store generates $9.2 million in annual tax revenue and $15.6 million in payroll. These conflicting figures reflect different methodologies. Critics measure net losses after accounting for business closures and wage suppression, while Walmart highlights gross additions without factoring in displacements. The truth likely lies somewhere in between, shaped by the unique characteristics of each community. One area where Walmart's impact is unequivocally positive is food access. The company operates over 400 stores in USDA-designated food deserts, providing fresh produce and healthy grocery options in communities where such items were previously scarce or unaffordable. A 2019 study found that proximity to a Walmart supercenter improved food security for low-income households and children, with the largest benefits observed in rural areas. In these regions, Walmart may be the only source of affordable, healthy food, and its presence can boost fruit and vegetable consumption by 18%, while lowering monthly grocery bills by $38 per person. However, this improved access often comes at the cost of local grocers, 72% of which close within 5 years of Walmart's arrival. Labor market dynamics within Walmart stores also reveal persistent challenges. While the company hires extensively from local unemployment roles, annual turnover remains high at 44%. This churn creates a revolving door effect, with workers cycling between Walmart and unemployment rather than advancing to better-paying roles. Analysts attribute this to a mismatch between the skills developed in Walmart jobs and those required for higher-wage positions elsewhere. Most Walmart roles focus on task repetition and customer service, offering limited opportunities for skill development that translate into upward mobility outside the company. Walmart's supply chain practices further shape local economies. The 2025 Supplier Diversity Report reveals that just 23% of store-level purchases are sourced from vendors within a 50-mile radius, compared to 45% at competing regional chains. This limits the economic multiplier effect, as dollars spent at Walmart recirculate only 1.3 times in the community, versus 2.8 times for independent retailers. The result is a net outflow of economic activity, as profits and procurement increasingly flow to national networks rather than local businesses. Price suppression, however, is a durable feature of the Walmart effect. Even businesses that survive the initial disruption find themselves operating in a new normal. A Kellogg school study tracking 82 grocery chains found that 5 years after a Walmart opening, surviving competitors maintained price points 12% to 15% lower than similar stores outside Walmart's influence. This persistent price pressure benefits consumers, but permanently alters the profitability and viability of local retailers. The commercial real estate market adapts as well. Data from CoStar Group shows that strip mall vacancies rise by 18 percentage points within 2 years of a supercenter's arrival, particularly among older properties unable to compete with Walmart's convenience and variety. Landlords often reposition these spaces for complementary services, such as urgent care clinics, fitness centers, or specialty food outlets, that do not compete directly with Walmart. Nevertheless, property tax assessments in these areas decline by an average of 22%, reflecting the diminished value of retail properties unable to match Walmart's drawing power. The agricultural sector is not immune to these shifts. Walmart's procurement model, which prioritizes consistency and low prices, has contributed to farm consolidation near distribution centers. USDA census data indicates that counties with Walmart distribution centers have seen 19% greater consolidation among farms compared to similar regions without them. The remaining farms increasingly tailor their output to Walmart's specifications, focusing on fewer crop varieties and stricter quality controls, which can limit agricultural diversity and local economic resilience. Walmart's growing e-commerce footprint introduces new layers of complexity. With 420 local pickup hubs leveraging store inventory, the company extends its price pressure into the digital realm. Competitors are now forced to match online prices for customers accustomed to Walmart's marketplace rates. According to Adobe Analytics, zip codes with Walmart pickup hubs see 14% higher e-commerce adoption rates than comparable areas without them, accelerating the shift in consumer behavior and further challenging traditional retailers. Municipal finances also undergo significant changes following a Walmart opening. Analysis of budget records from 42 communities reveals consistent patterns. Sales tax receipts typically jump by 18% in the first year, then stabilize at levels below pre-opening projections as local business activity consolidates. Meanwhile, property tax collections drop by an average of 9% due to declining commercial assessments, and public assistance costs rise by 12% as more workers qualify for Medicaid and SNAP. The net effect is a reshuffling of public revenue streams, with gains in some areas offset by losses in others. Longitudinal studies provide a more nuanced picture of Walmart's lasting impact. In Oklahoma, a 20-year analysis compared towns that allowed Walmart to those that resisted. Communities that blocked Walmart maintained higher densities of small businesses, 37% more, and enjoyed 12% higher median incomes, but they also faced 23% faster population decline as residents traveled to neighboring towns for better shopping options. The data suggests that the Walmart effect involves difficult trade-offs, preserving existing economic structures versus adapting to consumer demand for convenience and low prices. Despite criticism, Walmart points to overlooked benefits in its defense. The company's 2025 Economic Mobility Report shows that 28% of entry-level employees advance to higher-paying positions within 5 years, compared to a retail sector average of 19%. Walmart also hires a significant share of workers facing barriers to employment. 23% of associates have disabilities and 14% are formerly incarcerated, according to internal data. These factors, the company argues, contribute to greater economic inclusion, even as wage levels remain a point of contention. The totality of Walmart's influence is neither wholly destructive nor purely beneficial. The company's presence reshapes local economies in ways that are complex and often contentious, with measurable effects on businesses, workers, consumers, and public finances. Each supercenter becomes a gravitational force, bending the economic trajectories of everything within its reach. The consequences are not uniform, and the debate over whether Walmart's impact constitutes creative destruction or simple destruction continues in academic and policy circles. Yet, behind these community-level effects lies a corporate strategy that relies on precise internal hierarchies and pay structures. The economic blast radius of a Walmart store is the visible result of choices made at the highest levels of the company. Choices that have produced a workforce spanning the spectrum from entry-level poverty wages to executive compensation rivaling the top 1%. Understanding how Walmart's compensation structure is engineered to maintain this system reveals the logic and the gamble at the heart of the company's ongoing dominance. The compensation structure, from poverty to the 1%. Inside Walmart stores, the compensation structure draws a stark line between hourly associates and management, a system designed to both incentivize relentless efficiency and reinforce a steep internal hierarchy. In 2025, the spotlight is on market managers, whose pay packages have been overhauled to reflect their growing importance to the business. Starting in fiscal 2026, these multi-store supervisors will see their minimum base salary increase from $130,000 to $160,000, with the potential to earn a bonus equal to 100% of their salary and an annual stock grant of $100,000. Altogether, the maximum compensation for a market manager can now reach $620,000 per year, a figure that places them squarely in the top 1% of earners in most of the regions where Walmart operates. Store managers, who oversee a single location, start at $128,000 a year, with bonuses that can more than double their base pay depending on performance. These numbers stand in sharp contrast to the average hourly wage for associates, which is $16 per hour according to the Bureau of Labor Statistics. While the company has raised its minimum hourly wage to between $14 and $19 depending on location, the average full-time associate earns about $33,000 annually before taxes, well below the $37,470 federal poverty threshold for a family of 6. Walmart's pay stratification is not accidental. The bonus system for managers is engineered around 3 precise metrics: sales growth 30%, inventory shrinkage 20%, and profit before tax 50%. Each metric is measured and tracked in real time, pushing managers to pursue every possible operational efficiency. This might mean rearranging end caps to shave seconds off restocking, renegotiating with local utility providers for minor savings, or adjusting labor schedules to capture even the smallest reductions in payroll costs. The most successful store managers can save their locations upwards of $280,000 annually through these incremental improvements, and those savings flow directly into the bonus pool. The system is self-reinforcing. The more a manager can cut costs or boost sales, the larger their personal reward and the more closely their interests align with Walmart's corporate priorities. For hourly employees, the reality is different. In 2025, Walmart introduced a new longevity bonus of up to $1,000 per year for associates who have been with the company for 20 years or more. While this represents a nod to loyalty, it pales in comparison to management compensation. Many full-time associates, working an average of 34 hours per week at $16 per hour, find their annual earnings insufficient to meet the needs of a large household. As a result, a significant portion of Walmart's workforce qualifies for public assistance, and in at least 12 states, the company's employees represent the largest share of SNAP recipients. Walmart often points to its promotion pipeline as evidence of mobility, claiming that 76% of store managers started as hourly associates, but the average time to reach a management role is 12 years, and fewer than 3% of hourly workers ever make the leap to managing an entire store. The psychological effects of this pay structure ripple through the workforce. After the 2025 pay increases, management turnover dropped by 22%, indicating that higher compensation can buy stability at the top. However, hourly attrition remains high at 44%. Associates often express resentment when managers who approve overtime cuts or enforce strict scheduling rules are the same people collecting six-figure bonuses. Anonymous reviews on platforms like Glassdoor describe a culture where managers scrutinize time clock punches to the minute while receiving stock grants worth more than many associates earn in a year. These tensions manifest in subtle ways: higher inventory shrinkage in departments with disengaged staff, or slower checkout speeds during periods when managers are focused on hitting bonus targets. The compensation model shapes managerial behavior in predictable ways. Managers are incentivized to practice strategic understaffing, scheduling labor to exactly 97% of forecasted needs in order to capture a 3% savings bonus. They implement loss prevention theater, stationing greeters at entrances to deter shoplifting by 11% without investing in expensive security systems. Top-performing managers negotiate with suppliers for exclusive packaging sizes that optimize shelf space, generating incremental gains of around $18,000 per store each year. Even small operational tweaks, such as banning overnight air conditioning in the produce section, can increase profits by 9% in that department alone. Every decision is filtered through the lens of the bonus formula, with managers constantly weighing the trade-offs between short-term savings and long-term store performance. Cost-cutting measures often come at the expense of employee satisfaction. The elimination of overnight stocking crews, for example, saved Walmart $147 million company-wide, but required cashiers to take on restocking duties during their shifts. This policy led to longer wait times at registers, an increase of 38 seconds on average, and resulted in an estimated $89 million in abandoned purchases. While the net effect was still positive for Walmart's bottom line, the change strained staff morale. Similar patterns emerge when managers reduce HVAC usage or delay equipment replacements to hit profit targets. Hourly workers bear the brunt of these austerity measures, while management reaps the financial rewards. Walmart's leadership frames this pay structure as a way to make managers feel like owners. The analogy holds up mathematically. A store manager overseeing a $100 million supercenter that produces $3 million in annual profit can earn a compensation package that resembles a 2.5% ownership stake in the business. Unlike traditional profit-sharing plans, this system requires no capital investment from the manager. Instead, it converts operational performance directly into personal earnings. In many ways, the structure is more aggressive than the equity-based compensation models found at other Fortune 500 companies, directly tying individual pay to store-level results. Critics argue that the promise of upward mobility is overstated. While 28% of hourly associates eventually move into department manager roles, paying $45,000 to $65,000, the path to store manager is narrow. Each supercenter employs a single manager, but averages 350 associates, making the odds of promotion slim. Walmart counters that its 76% internal promotion rate for store managers outpaces retail peers like Target, 68%, and Kroger, 59%. But detractors note that few competitors create such dramatic earnings cliffs between frontline and management roles. Market managers occupy the very top of this pyramid. With total compensation packages that may now reach $620,000, these multi-store supervisors are paid more than many corporate vice presidents, despite remaining close to day-to-day retail operations. Their responsibilities extend beyond a single location, giving them the ability to consolidate deliveries, optimize staffing across stores, and negotiate regional supplier contracts. These efficiencies can save Walmart as much as $1.2 million annually per 12-store territory, directly boosting the bonuses of market managers. The expanded stock grants further tie their compensation to the company's overall performance, aligning their interests with corporate headquarters rather than individual store teams. The financial impact of these pay increases is visible in Walmart's quarterly reports. Raising management compensation added $157 million to quarterly selling, general, and administrative expenses, contributing to a 150 basis point compression in operating margins. Yet, the investment appears to be paying off. After the new pay structure was implemented, same-store sales growth accelerated from 3.1% to 4.3%. Stores led by managers hired since the overhaul report 11% faster inventory turnover, a critical factor when Walmart earns its entire 3% margin every 42 days through rapid stock rotation. Supplier relationships add another layer of complexity. Walmart managers aggressively enforce vendor chargebacks, penalties for late deliveries or incorrect shipments, which now generate $2.1 billion annually and account for 6.3% of operating income. These chargebacks are often necessary to meet the profit targets that drive bonus payouts, but they can strain relationships with smaller suppliers. For some vendors, the cost of complying with Walmart's exacting standards can exceed 18% of annual revenue, forcing operational changes that impact their business with other retailers. Walmart's approach to pay reflects broader trends in the retail sector. Labor accounts for just 9.8% of Walmart's operating costs, compared to 15% to 20% at specialty retailers. So the company focuses less on hourly wage increases and more on extracting maximum efficiency from its workforce and real estate. The new compensation model has pushed supercenter sales per square foot from $430 to $511, a jump that underscores the importance of operational discipline. The underlying wager is that the motivational power of high six- and seven-figure compensation will outweigh any morale damage caused by extreme pay disparities between managers and hourly staff. When compared to other industries, Walmart's structure stands out for its reliance on sharp incentives at the top. Market managers earning $620,000 oversee $1.2 billion in annual revenue, similar to tech middle managers responsible for comparable revenue streams. But where tech companies often distribute profits more broadly among technical staff, Walmart focuses rewards on those who can extract even fractional improvements from enormous sales volumes. At Walmart's scale, a 0.1% efficiency gain produces $680 million in additional profit, enough to fund over 1,000 market manager salaries without eroding margins. The psychological effects of these incentives are well documented. Behavioral economists at Purdue University found that Walmart managers subject to aggressive bonus targets are 23% more likely to take operational risks, such as lowering safety stock levels or delaying equipment maintenance, compared to managers under the previous pay model. Most of these gambles pay off, but when they fail, through stockouts or equipment breakdowns, the consequences can be significant for both customers and employees. The company's pay philosophy is shaped by the realities of inflation as well. While Walmart has raised starting wages by 27% since 2020, cost of living adjustments have lagged behind. In 2024, the company implemented a 3.2% COLA, and average salary increases hovered around 3.6%, failing to fully offset the impact of rising prices on workers' purchasing power. For many associates, wage gains have not kept pace with the cost of essentials, and the gap between frontline and management pay has only widened. Despite these disparities, Walmart's compensation model is justified internally by its results. Same-store sales growth now outpaces competitors like Target by 180 basis points, and analyst consensus attributes $800 million in annual shareholder value to the management intensity created by the bonus structure. Stores led by high-earning managers report 15% better OSHA compliance and 9% higher customer satisfaction. Evidence that well-structured incentives can drive both operational excellence and regulatory adherence. Ultimately, Walmart's experiment with extreme pay stratification exposes an uncomfortable reality about the economics of low-margin retail. Survival often depends on aligning management behavior with the smallest possible improvements in efficiency and profit. The system works not because it is equitable, but because it channels competitive drive in ways that benefit the company's bottom line. For employees at the bottom of the pay scale, the promise of advancement remains a powerful motivator, even if the odds are long. This dynamic sets the stage for one of Walmart's most effective retention tools, a strategy built not just on financial incentives, but on the visibility of those who succeed. Within Walmart's vast network, one of the company's most calculated tools for retention is what executives and analysts call the halo effect. This is not simply about paying managers more. It's about making the success of a few highly visible, highly compensated leaders central to the story Walmart tells its workforce. The company's communications, recruitment materials, and even break room posters feature stories of cashiers who work their way up to store manager roles, now earning $300,000 or more. Market managers, who can earn as much as $620,000 in total compensation, are presented as the pinnacle of achievement. The message is clear: advancement is possible, and the rewards are transformative. The halo effect works by creating a sense of aspiration among a workforce that knows mathematically most will never reach those heights. Walmart's leadership understands that the mere existence of these high-paying roles can be more motivating than incremental wage increases for everyone. Internal documents make this explicit. Eventually, people get used to higher pay. One memo notes, but aspiration lasts longer. The company's strategy is to keep that aspiration alive by making the path to management highly visible, even if it is narrow and steep. This approach is reinforced every day on the sales floor. Team meetings are punctuated with announcements about manager bonuses, with applause for those who made it. Store-wide emails circulate when someone is promoted from hourly associate to a salaried manager, and regional meetings highlight the stories of those who rose through the ranks. The effect is twofold. It signals to current employees that upward mobility is possible, and it serves as a recruiting tool for new hires who might otherwise be put off by the realities of retail work. The company's internal promotion rate for store managers at 76% is higher than Target's 68%, a statistic that is cited frequently in both internal and external communications. But the path to management is long. On average, store managers have put in 12 years before earning their promotion. The psychological impact of the halo effect is most evident in the way it shapes workplace culture. Walmart creates what economists call a tournament model among its employees. Every supercenter has a single store manager, but employs hundreds of hourly workers. The odds of promotion are slim, but the potential reward is so substantial that many are willing to work through difficult conditions, long hours, and relentless performance scrutiny for a shot at advancement. Department manager roles, which pay $45,000 to $65,000, are filled internally within about 18 months on average, providing intermediate steps that keep the hope of further promotion alive. The Live Better You program, which covers college tuition for employees, is another rung on this ladder. Though only about 8% of employees participate due to the demands of retail schedules. Walmart's strategy is particularly effective in the current labor market, where finding qualified managers is increasingly difficult. The company prefers to promote from within. Just 24% of store managers are external hires, because internal candidates have already adapted to the company's operational culture and demands. The skills required to succeed as a manager at Walmart are highly specific. Optimizing inventory flow, mastering labor scheduling algorithms, and understanding the nuances of local regulations and supplier relationships. External hires, even those with retail experience, often struggle to match the performance of those who have spent years navigating Walmart's systems. The company's focus on internal advancement serves another purpose. It helps maintain Walmart's culture and operational discipline. Managers who rise through the ranks have accumulated years of institutional knowledge, how to negotiate with local zoning boards, which suppliers are flexible on delivery terms, and which community organizations to support. This knowledge is not easily replaced, and it directly affects the profit metrics that determine bonuses. Data from 2025 shows that internally promoted managers achieve bonus targets more often than external hires, reinforcing the value of this approach. The demands placed on Walmart managers are significant. Store managers routinely work 55-hour weeks, with the majority reporting that they have missed important family events due to work obligations. Market managers, who oversee a dozen or more stores across multiple counties or even states, spend up to 70% of their time traveling. The company offers $15,000 relocation bonuses for those willing to move, but there are no guarantees about spouse job placement or school district preferences. This level of commitment weeds out all but the most dedicated candidates. The result is a management tier that is both highly compensated and highly invested in the company's success. These roles are not simply about overseeing operations. They involve a relentless focus on efficiency and cost control. Managers are expected to implement significant labor optimization, identify process improvements, and drive operational changes that can save their stores or regions 6 figures annually. For example, a store manager might redesign stocking routines to reduce spoilage, negotiate with local vendors for better terms, or adjust staffing to match projected customer traffic with precision. The expectation is not just to meet targets, but to surpass them, with the knowledge that their personal compensation is directly tied to these outcomes. Walmart CEO John Furner has described the goal as making managers feel like owners. This is not just a metaphor. Store and market managers receive stock grants as part of their compensation, aligning their interests with the company's long-term performance. The structure is designed to push managers to think beyond day-to-day operations and take responsibility for every aspect of their store's financial health. This sense of ownership is reinforced by the high visibility of manager compensation, which is regularly referenced in company communications. The company's reliance on the halo effect is, in part, a response to broader demographic and economic trends. With an aging population and declining labor force participation, especially among younger workers, Walmart faces an increasingly challenging environment for recruiting and retaining talent. Over a quarter of Walmart's management pipeline is expected to reach retirement age by 2030, and fewer young workers view retail as a desirable long-term career. To address this, Walmart has begun targeting second-career professionals, including former military officers, who now make up over a fifth of external management hires. These candidates bring structured thinking and leadership skills, but adapting to the unpredictable realities of retail can be a challenge even for them. The economics behind the halo effect are compelling. The cost of replacing a single store manager is estimated at $150,000 in lost productivity and recruitment expenses. Hourly turnover, by contrast, costs about $3,200 per employee. While hourly turnover remains high at 44%, manager turnover is much lower, at 12%. By investing in retention at the management level, through both high compensation and the promise of advancement, Walmart generates substantial savings. Across 4,700 U.S. stores, reducing manager turnover by just 10% can save the company $70 million annually. The effectiveness of this strategy is measurable. Corporate reports indicate that stores with managers earning maximum bonuses experience improved compliance with operational standards and higher customer satisfaction scores. Employee turnover among hourly workers is 18% lower in these locations, despite identical wages. The prospect of advancement and the visibility of those who have achieved it encourages employees to stay and perform even under demanding conditions. Walmart amplifies this effect by celebrating promotions publicly, announcing manager achievements at company-wide meetings, and displaying compensation milestones prominently in break rooms. Critics of the halo effect point to the psychological strains it can create. The relentless focus on performance metrics and the pressure to achieve ever higher targets can lead to burnout and stress among managers. The demands of the job, long hours, frequent travel, and high expectations, are not suited to everyone, and some employees who pursue advancement ultimately find the sacrifices too great. While the company's internal data highlights improved retention and performance metrics, it also acknowledges the toll that these roles can take on personal well-being. Walmart's approach to retention reflects a broader trend in American business, where the promise of upward mobility is used to motivate workers in lieu of widespread wage increases. In this model, the dream of advancement is as important as the reality. Employees are willing to accept difficult working conditions and modest pay if they believe that exceptional rewards are within reach, even if only for a select few. This is not unique to retail. Similar dynamics can be seen in technology firms, law practices, and other industries where a small number of highly paid positions serve as aspirational targets for the many. The sustainability of the halo effect is not guaranteed. As wage transparency increases and employees become more aware of the true odds of advancement, the motivating power of visible success stories may diminish. Recent labor organizing efforts and calls for greater pay equity have cited the gap between manager and worker compensation as a source of frustration. Yet, for now, Walmart's strategy continues to deliver results where it matters most, retaining the managers who are responsible for maintaining razor-thin margins and operational discipline. Across thousands of stores, the company's ability to hold on to key talent is increasingly important as labor market conditions shift and external pressures mount. Automation has changed the nature of many retail roles. Self-checkouts now account for nearly a third of transactions, but the need for skilled, committed managers remains. These individuals are tasked with navigating unpredictable challenges, from supply chain disruptions to shifts in consumer demand, all while keeping costs in check and performance high. Walmart's use of the halo effect is not just a matter of internal policy. It is a reflection of the company's broader influence on the labor market. By making the possibility of extraordinary advancement central to its employment proposition, Walmart shapes expectations and behaviors across its workforce. The result is a system where aspiration becomes a tool for managing turnover, driving performance, and maintaining control over labor costs. This dynamic does not exist in isolation. Walmart's scale and influence extend far beyond its own employees, shaping local economies and labor markets wherever it operates. The company's approach to compensation and retention is just one part of a much larger story, one in which Walmart's presence can alter the balance of power in entire communities, with consequences that reach well beyond the walls of its stores. The monopsony power of Walmart. Walmart's role as a dominant force in American retail is underscored by its monopsony power, the ability to act as the primary buyer of labor in many local markets. This status gives the company a unique influence over wage standards and working conditions, often setting the baseline for what other employers in the area can offer. In more than a third of the counties where Walmart operates, it stands as the largest private employer, a position that enables it to shape the economic environment for thousands of workers and businesses. This influence is not simply theoretical. It is reflected in measurable changes to local economies. When Walmart enters a community, its sheer scale allows it to dictate pay rates that competitors must match or risk losing their workforce. The outcome is a ripple effect that extends far beyond Walmart's own payroll. A comprehensive study tracking 92 new supercenter openings found that, within 5 years, retail wages in affected counties declined by an average of 6%. This downward pressure was not limited to Walmart's own employees. Competing grocery stores, hardware shops, and pharmacies reduced their starting pay by as much as 8% to remain viable, while restaurants and service businesses in the same areas cut wages by 4.5%. The effect is not isolated to retail. It spreads to other sectors as local wage benchmarks shift in response to Walmart's presence. The consequences of this wage suppression are significant. The same study documented an 8% rise in poverty rates in communities following a Walmart opening, with rural areas experiencing even steeper increases. This is attributed to several factors. Local businesses closing and their owners becoming hourly workers, full-time jobs being replaced with part-time positions, and depressed wages leading to lower household incomes. In these areas, the economic fabric of the community changes. USDA data shows that participation in the Supplemental Nutrition Assistance Program, SNAP, climbs 13% in zip codes with Walmart supercenters, compared to demographically similar areas without them. As more workers find themselves earning less, reliance on public assistance grows, and the cycle of poverty deepens. Walmart's leadership often points to the benefits it brings to local economies. The company's 2025 Community Impact Report highlights the creation of $18 million in annual local wages and $9.2 million in tax revenue per store. Corporate-sponsored studies emphasize the consumer savings generated by Walmart's low prices, estimating that households save an average of $1,247 each year. While these savings are real, economists caution that the benefits are not evenly distributed. Higher-income families, who can afford to buy in bulk and take advantage of promotions, tend to capture a larger share of these savings. Meanwhile, low-wage workers, many of whom are directly affected by wage suppression, bear the brunt of the negative impacts. The mechanics of Walmart's monopsony power become clear in local case studies. In Dalton, Georgia, the arrival of a new Walmart in 2019 coincided with a 7.8% drop in retail wages across Whitfield County by 2024. Local hardware stores, previously paying $15 an hour, reduced their starting offers to $12.50 to compete. The closure of 3 family-owned grocers eliminated nearly 100 jobs that paid an average of $17 per hour, replaced by over 100 Walmart positions averaging 32 hours per week at $14.50. Walmart's claims of a $200 million economic impact for the region did not account for these substitutions or the shift in job quality. The long-term effects are visible in community financial health. A Federal Reserve study of 12 towns with new Walmart stores found that commercial property values in business districts near supercenters declined by 22% over 5 years, as local businesses shuttered and retail activity consolidated. Sales tax revenues, which often spiked by 15% immediately after a Walmart opening, eventually plateaued at levels below pre-opening projections. The most enduring change was in entrepreneurship. Small business formation rates slowed by 18% compared to control communities, suggesting a lasting deterrent to local investment and innovation. Walmart's power as a buyer extends beyond labor to its relationships with suppliers. The company's vast purchasing volume enables it to dictate terms to small and medium-sized vendors, often forcing them to accept lower margins in exchange for access to Walmart's shelves. For example, Mount Olive, a regional pickle producer, found that Walmart quickly became its largest customer, accounting for 28% of sales. However, the price concessions demanded by Walmart reduced Mount Olive's margins by 40%, pushing the company to cut costs, often through layoffs or reduced hours. Economic models suggest that for every $1 million in cost-cutting driven by Walmart's supplier demands, approximately 1.8 local jobs are lost, compounding the effect of wage suppression on the broader community. The broader economic consequences are substantial. As Walmart consolidates its position as the leading employer and purchaser in a region, other businesses struggle to compete. Over time, this can erode the local tax base, reduce consumer spending, and diminish the overall economic vitality of the area. Public services suffer as property and sales tax revenues decline, and communities may experience a reduction in the quality of infrastructure, schools, and health services. The loss of independent businesses also means less local decision-making and a diminished sense of community identity. One of the most visible hidden costs of Walmart's low-wage model is the burden it places on public assistance programs. Research from the University of California, Berkeley, estimates that Walmart employees rely on $6.2 billion annually in public benefits, including Medicaid, housing assistance, and SNAP. This figure reflects the fact that many Walmart workers, despite being employed full-time, do not earn enough to meet basic living expenses. The impact is not limited to Walmart's direct employees. As the company's wage standards become the norm in a local market, workers at other businesses may also find themselves qualifying for public assistance, multiplying the cost to taxpayers. Labor market dynamics change under monopsony conditions. In a competitive market, workers can leverage offers from multiple employers to negotiate for better pay and conditions. In communities dominated by Walmart, that leverage disappears. Bureau of Labor Statistics data indicates that wage growth for retail workers in these markets lags nearly 3 percentage points behind the national average. Quit rates are lower, by about 19%, not because workers are more satisfied, but because alternative employment options are scarce. The result is a labor market where mobility is limited, bargaining power is weak, and wages remain stagnant. The savings that Walmart delivers to consumers are real, but come with trade-offs. Households near Walmart stores spend nearly 6% less on groceries, but aggregate annual income in these areas drops by about 3% due to wage suppression. For families with two earners in affected sectors, this means that annual savings at the checkout are often outweighed by losses in earnings. Lower-income households are hit hardest, as they spend a greater share of their income, over 60%, on Walmart-affected categories like food and household essentials. The balance between consumer benefit and worker cost is a central tension in Walmart's business model. Some local governments have attempted to address the effects of monopsony power. In Ohio, several towns now require labor impact statements for new big-box developments, forcing retailers to demonstrate that their presence will not depress wages below federal poverty guidelines. Washington state passed a law in 2025 that bans employers controlling over a quarter of local retail jobs from qualifying for tax incentives, though Walmart challenged the law in court. These efforts reflect growing awareness of the need to balance economic development with protections for workers and small businesses. Urban areas are somewhat insulated from Walmart's monopsony power. In cities with diversified economies and robust transportation networks, workers have more options and employers must compete for talent. For example, in Chicago, Walmart's share of retail employment is too small to dictate wage standards across the city. In contrast, in rural communities like Martinsville, Virginia, Walmart captured more than half of all retail jobs within 3 years of opening, giving it near total control over local wage setting and employment conditions. Walmart's dominance is not static. The dynamics of the labor market are shifting, and the company has had to adapt. In the years following the pandemic, tight labor markets forced Walmart to increase starting wages by 27% in competitive regions. Automation is also reshaping the landscape. Self-checkout systems now handle nearly a third of all transactions, reducing the total number of jobs Walmart offers in each market. While these changes may reduce the company's direct control over local labor markets, they also present new challenges for communities that have relied on Walmart as a major employer. Economic theory suggests that monopsony power is eventually checked by market forces, as workers seek better opportunities or new competitors emerge. Yet, Walmart has proven adept at maintaining its position. When Amazon opened a fulfillment center in Lubbock, Texas, Walmart responded by raising wages just enough to match Amazon's starting rates, without exceeding them. This approach ensures that Walmart remains competitive without driving up wages across the broader labor market. The company's careful calibration of pay and benefits allows it to retain its workforce without fundamentally altering the wage structure in the regions it dominates. The paradox at the heart of Walmart's monopsony power is that it serves as both a suppressor of wages and a promoter of select upward mobility. While the company's practices contribute to lower average earnings and higher poverty rates, it also offers a path to substantial advancement for a small segment of employees. Walmart promotes a significant share of its managers from within, creating highly visible examples of economic mobility. However, these opportunities are limited, and for the vast majority of workers, the prospect of advancement remains distant. The sustainability of this model is increasingly in question. As generational attitudes shift, younger workers express less tolerance for stark pay disparities and are more likely to support unionization efforts. In 2025, unionization attempts at Walmart locations near college towns rose by 38%, reflecting growing discontent with the status quo. At the same time, the company's pricing power continues to attract customers, even as labor market pressures and regulatory scrutiny intensify. Walmart's ability to define the rules of the local economy has far-reaching implications. Its monopsony power shapes not only wages and job opportunities, but also the long-term health of communities, the viability of small businesses, and the burden on public resources. As the landscape of retail employment evolves, the strategies Walmart uses to maintain its dominance will face new tests. The pressures building within this system are setting the stage for changes that could reshape the company's approach to compensation, the future of Walmart's compensation labor relations strategy in the years ahead. Looking ahead, the future of Walmart's compensation strategy will be shaped by a collision of economic pressures, regulatory shifts, and changing workforce expectations. The company stands at a crossroads where its legacy of relentless cost control meets a labor market that is less forgiving of the old playbook. Walmart's ability to maintain its dominance will depend on how it adapts its pay model, balancing the need to attract and retain talent with the imperative to keep prices low and margins stable. Labor shortages are already pushing Walmart to reconsider its approach. With an aging workforce and a shrinking pool of available workers, the company can no longer count on a steady supply of low-wage labor. Nearly 28% of Walmart's managerial staff is set to retire by 2030, and younger workers are increasingly skeptical of retail careers that demand long hours and offer slow advancement. The 44% annual turnover rate among hourly associates is not just a statistic. It represents a persistent drain on productivity and a growing financial burden, as each replacement costs the company thousands in recruitment and training. Walmart's internal promotion system, which has long served as a retention tool, now faces resistance from a generation that expects quicker progress and more transparent career paths. In response, Walmart is experimenting with ways to make its compensation model more appealing without undermining its core philosophy. One area of focus is the creation of more intermediate roles, such as front-end managers who oversee self-checkout operations at salaries around $65,000. These positions provide a bridge between hourly work and store management, offering a clearer path upward for those who want to advance. The company is also testing targeted market premiums, adding pay bumps for managers in high-cost or highly competitive regions. These adjustments are incremental, but signal a willingness to adapt to local labor conditions rather than imposing a one-size-fits-all approach. Pay transparency is another force that is reshaping the landscape. New laws in states like Illinois and Massachusetts now require employers to disclose pay scales and job postings, making wage differentials more visible to current and prospective employees. For Walmart, this means the stark contrast between floor staff and management compensation is no longer hidden. The company's strict hierarchy, once justified by the promise of mobility, now risks fueling resentment as employees see the exact numbers their supervisors earn. Skills-based pay models, where compensation is tied to specific abilities rather than job titles, are gaining traction elsewhere in the industry. Walmart has been slow to embrace this trend, preferring to maintain rigid compensation bands that reinforce its internal structure. Unionization efforts are adding another layer of complexity. While Walmart has historically resisted organized labor, recent years have seen a rise in union activity, especially in markets with younger, more educated employees. Organizers often cite pay disparities and limited advancement opportunities as key grievances. Walmart's response has been to selectively raise starting wages, 27% since 2020, and to invest in anti-union campaigns. These tactics have succeeded in staving off unionization for now, but continued labor tightness and shifting public sentiment could force further concessions. The company's leadership is aware that the threat of unionization is not going away, and that the cost of ignoring worker demands could be higher in the long run than incremental pay increases. Automation is poised to play a central role in Walmart's future compensation calculus. The company has invested heavily in technology across its supply chain, from self-checkout kiosks that now handle nearly a third of all transactions to fully automated distribution centers where robotic arms and driverless forklifts handle physically demanding work. Each new automated facility is projected to save $90 million annually, a figure that underscores the scale of Walmart's cost-cutting potential. These savings create an opportunity to fund higher wages, but the company's track record suggests that price reductions and margin preservation will remain the top priorities. When Walmart raised wages in 2015, its stock dropped 10% after investors learned of the near-term profit impact, a lesson that continues to shape executive decision-making. The shift towards automation also changes the profile of the workforce Walmart needs. As repetitive tasks are handed off to machines, the company must hire and retain higher-skilled technicians to maintain and operate new systems. These roles command higher pay, often $25 an hour or more in automated distribution centers, nearly double the typical wage for warehouse workers. This evolution creates upward pressure on average pay, even as the total number of jobs may decline. Walmart's challenge will be to integrate these new roles without disrupting its finely tuned cost structure. Ethical scrutiny of Walmart's pay hierarchy is intensifying. The company's decision to pay market managers up to $620,000 a year stands in sharp contrast to the reality faced by hundreds of thousands of employees who qualify for Medicaid or other public assistance. CEO John Furner has defended the practice, arguing that high compensation for managers makes them feel like owners and drives performance. Labor advocates, however, view this as a symptom of a broken model that rewards a select few while leaving many behind. Public sentiment is shifting, with more Americans questioning whether such disparities are a necessary feature of modern business or a failure of corporate governance. Investor expectations remain a powerful constraint on Walmart's compensation strategy. The company trades at a fraction of the sales multiples enjoyed by tech giants like Amazon, a reflection of Wall Street's skepticism about retail's growth prospects. Any move to raise wages is scrutinized for its impact on margins, and history shows that investors are quick to punish deviations from cost discipline. Walmart's $5.8 billion in annual share buybacks signals to shareholders that management remains focused on delivering returns, even as it navigates the complexities of a changing labor market. The company's leadership knows that any significant shift in compensation policy must be offset by gains in efficiency, new revenue streams, or other cost reductions. Regulatory changes are also on the horizon. States are beginning to experiment with laws that require large employers to meet higher wage floors or to assess the labor impact of new store openings. While Walmart has managed to secure exemptions in some rural areas, the trend is clear. Policymakers are more willing than ever to challenge the traditional retail labor model. The company is preparing for this new environment by diversifying its revenue base, investing in advertising, membership programs, and data sales to help cushion the impact of potential increases in labor costs. These efforts are not a substitute for structural change, but they provide a buffer as Walmart adapts to a more demanding regulatory climate. The future of Walmart's compensation model will be shaped by 5 key trends. First, tightening labor markets mean that the company can no longer rely on a surplus of workers willing to accept low wages. As the population ages and participation rates fall, Walmart will have to offer more competitive pay to attract and retain talent, particularly for demanding management roles. Second, the rise of automation will continue to displace low-skill jobs while creating demand for higher-paid technical positions. This shift will require a rethinking of the company's approach to training, recruitment, and pay scales. Third, generational shifts in worker expectations, especially among millennials and Gen Z, will put pressure on Walmart to offer more flexible schedules, quicker advancement, and a better work-life balance. Fourth, increasing demands for pay transparency will make it harder to justify extreme disparities, forcing the company to reconsider how it communicates and structures its compensation packages. Finally, investor pressure for margin preservation will continue to limit how far Walmart can go in raising wages without offsetting those costs elsewhere. To address these challenges, Walmart is making a series of targeted adjustments. The company has introduced new management roles focused on overseeing self-checkout and e-commerce operations, providing stepping stones for ambitious employees. In high-cost markets, it offers premium pay to compete with rivals like Amazon and Target. Stock grants for market managers have been expanded, allowing the company to align interests without committing to permanent base pay increases. These moves are designed to preserve the core logic of Walmart's compensation system, rewarding those who deliver results, while making incremental improvements that address emerging pressures. Walmart is also exploring new models of employee motivation. In select stores, the company has piloted gain-sharing programs, where entire teams receive bonuses based on operational improvements. This approach seeks to address the morale issues that arise when individual manager bonuses are funded by cost-cutting measures that affect the broader workforce. Another experiment gives department managers small equity stakes tied to the performance of their sections, creating a sense of ownership without the complexity of full profit sharing. These initiatives are in their early stages, but they reflect a recognition that the old model may not be enough to sustain engagement and productivity in the years ahead. Economic volatility could accelerate changes to Walmart's pay strategy. The company's resilience during the 2023 inflation spike, when it gained market share as consumers traded down, demonstrates its ability to weather shocks. Because Walmart's margins are so thin, even small increases in efficiency can fund selective wage hikes. Analysis shows that a $1 per hour increase for all hourly employees would reduce annual profits by about 8%, a manageable hit compared to what competitors would face. This flexibility allows Walmart to evolve its compensation model incrementally, rather than resorting to disruptive overhauls. Union activity remains a wild card. Labor organizers have shifted tactics, drawing comparisons between Walmart and competitors like Costco, which pays hourly workers significantly more while maintaining strong profitability. Walmart counters by pointing to its vast scale and the complexities of managing compensation across thousands of stores. Still, the pressure is mounting, and the company may eventually be forced to make broader concessions to avoid the risk of widespread unionization. Walmart's international operations offer another lever. In markets like Mexico and India, the company operates at higher margins and adapts its pay structures to local conditions. This flexibility could inform future strategies in the U.S., allowing Walmart to segment compensation by region or market type. However, the rise of pay transparency laws complicates efforts to maintain different pay scales in different locations, as employees and the public gain access to more detailed compensation data. Ultimately, investors will continue to set the boundaries for what is possible. Walmart's $760 billion market cap depends on maintaining operating margins within a narrow range, and any changes to compensation must fit within this framework. This is why the company's leadership emphasizes technology and process optimization as the primary means of funding pay increases. When Walmart last raised wages in 2015, the 10% drop in its stock price made clear that shareholder priorities remain at the forefront of decision-making. The company's scale remains its greatest asset. With thousands of stores processing millions of transactions each week, even minor improvements in efficiency can generate the savings needed to support selective pay increases. Training cashiers to scan items slightly faster or reducing inventory discrepancies by a fraction of a percent can translate into hundreds of millions in annual savings. These micro-optimizations form the backbone of Walmart's compensation strategy, allowing it to reward high performers while maintaining its commitment to low prices. At its core, Walmart's pay model is engineered to keep employees striving for advancement, even if only a small fraction make it to the top. The visibility of high manager salaries serves as both a motivator and a justification for the system as a whole. As long as workers believe in the possibility of upward mobility, and as long as operational gains can fund selective rewards, Walmart's model is likely to endure. The debate over its ethics and sustainability will continue, but the underlying mechanics remain clear: efficiency, scale, and relentless focus on cost control. This approach, built on extracting the maximum value from every role, sets the stage for the company's ongoing success, and for the difficult questions that come with it. Walmart's model stands on a paradox. It can pay top managers extraordinary salaries only by driving relentless efficiency throughout the organization. The company's commitment to everyday low prices is made possible by a system that relies on micro-optimizations, strict cost control, and an uncompromising focus on margins. Every layer of the business, from logistics to staffing, is engineered to extract savings wherever possible, allowing Walmart to offer prices 10 to 25% below competitors and still reward its highest performers. This approach has delivered clear benefits to consumers, particularly low-income families, but it also raises questions about whether such a model can be replicated or sustained without inheriting its contradictions. As Walmart faces new pressures from technology, labor markets, and public scrutiny, its future will depend on how well it can adapt its core strategy while maintaining the balance between efficiency and opportunity.